Hey you guys, welcome back. I'm Jeff and we are the Animal Donut family. Thank you so much for clicking play. Hopefully you also click that like button as well and subscribe to the channel. I think we are on the brink of something new and something different on this channel. I'm wearing my Lucky Charms shirt, as you can see, because I feel like we're going to look back on this video, I think, in a year, and some of the stuff that we covered, we're gonna go, oh, wow, yes, that worked. And some of the things, maybe they don't. I don't know. But I think this is groundbreaking stuff. Picks and shovels. That's kind of the theme. What I'm gonna do here is I just wanna start off reading you just a tiny little bit from this article, because this is kind of what gave me the springboard to do some research that helped me to discover 7 stocks that I'm going to talk about in this video. 7 new stocks. I don't think I have mentioned a single one of them in all the time I've been making videos. I don't own stock in any of these companies yet, and not financial advice. Okay, the headline: amid explosive demand, America is running out of power. A major factor behind the skyrocketing demand is the rapid innovation in artificial intelligence, which is driving the construction of large warehouses of computing infrastructure that require exponentially more power than traditional data centers. AI is also part of a huge scale-up of cloud computing. Tech firms like Amazon, Apple, Google, Meta, and Microsoft are scouring the nation for sites for new data centers, and many lesser-known firms are also on the hunt. So that right there is the foundation for what I'm going to talk about in this video.
It's simply that the absolute magnitude of demand for compute power is growing at an astronomical rate. So we're seeing a lot of the new chips. That's great. But every new chip does use more electricity. It's just that every new chip has massively more compute capability. So essentially, compute growth is astronomical, power demand growth very high, about 100% a year for generative AI, even with that improvement in efficiency of the chip. So this is really a byproduct of just compute growth.
And as we stand, how close are we to putting too much pressure on the grid? Are we close to capacity already or not?
We are close to capacity, if not at capacity, in several markets. In our note, we analyzed all the power markets around the world, and we're seeing major pressures in places like Dublin, Ireland, Santa Clara, California, parts of Southeast Asia. So we're there in certain parts, but other markets, other states, et cetera, really want to welcome new data centers. So it is a bit of a mix. It's just that, broadly speaking, planning to get new data centers onto the grid is very arduous, and the delays are increasing to get that done.
And in terms of then what's next and how you should play this, are we talking about people that are going to help expand the grid, people that are just building data centers where there is power? What's the actual themes behind this?
Yeah, great question. It's not so much the grid providers, it's the power providers that can provide the fastest time to market for data centers. For example, instead of owning a grid company that's going to slowly increase their spending on the grid, I say slow, less than 10%, what we're interested in is a power supplier like a nuclear power plant owner that can provide an alternative to the grid, provide power much more quickly, and achieve much higher margin growth as a result.
I think that as far as picks and shovels go, that correctly identifying the major players who are going to be able to meet the needs, this may be the next picks and shovels. Full disclosure, as I mentioned, I do not own any of these companies right now, although because I'm doing this research and getting a grasp, I believe that I will be buying stock in at least one of these companies I'm going to talk with you about today, and maybe more than one. And disclaimer, not financial advice. Okay, let's get started. I have 7 stocks I want to talk with you about. So what I'm going to do is just give you guys a little overview of each of these companies. Nextera Energy, and the ticker is NEE. What sets this company apart from the others is that I would characterize this as a clean energy company, meaning that it's developing wind and solar initiatives, but it's not involved in nuclear energy. This company, along with the next few I'm going to mention, are more established companies in that they're able to pay investors dividends. The current dividend yield is 3.5% for Nextera Energy. Just a little bit from Value Line, they say Nextera Energy closed out its 2023 campaign strongly and provided an upbeat outlook for the year. And then they also said, while management has maintained a long-term growth goal of 6 to 8% for annual earnings per share, the equity valuation has been pricing in higher gains. So they're saying that the stock price is going out, predict the company will deliver more than 6 to 8%. And, nobody can predict what's going to happen. I would say that Nextera Energy is a more established company than some of the others we're going to talk about later. And the dividend yield, as I mentioned, is 3.5% for Nextera. Now, the next company I'm going to mention is Duke Energy. DUK is the ticker. And what's interesting about this is also a huge power supply company. And they have a 4.3% dividend yield. So this is, again, a more established company. And what strikes me about this company is that nuclear power is one of their main sources of energy. So I want you guys to keep that in mind, because nuclear has the potential to provide more power and at low expense than some of the other companies that just provide electricity or natural gas. And just reading you a snapshot here, Duke Energy's earnings will likely advance nicely this year. The company should continue to benefit from regulatory mechanisms and increased rates. This is from Value Line. This issue is best suited for income-oriented accounts. The stock dividend yield remains above average for a utility. So what I want you to see is that Duke is probably not a company that one's going to expect to grow 15 or 20% in the future, because it's already a very large company. But this one offers a high dividend yield, which might appeal to some kinds of investors. All right, that's the second company. Number 3 is Exelon Corp, and the ticker symbol is EXC. This also has a really high dividend yield, 4.3%. This is also a very large power generation company. They're also involved in nuclear energy, and their dividend yield is 4.3%. And the summary from Value Line just says, this issue is best suited for conservative, income-oriented accounts. And I think that is code for this stock is probably not going to be going up 15 or 20% in revenues or earnings each year. It's a more conservative company. They're very large, but they do have that dividend. So nuclear energy for Exelon, which is also similar to Duke. Now, that is Nextera, Duke, Exelon. All right, we're on to the fourth one, and this is Southern Company. Ticker symbol is SO. This also has a 4.1% yield, so very high yield company, and this is also involved in nuclear energy. Southern Company's Georgia Power subsidiary increased its cost estimates for its nuclear construction project. Georgia Power now looks for the total cost of the Vogtle nuclear reactor to be about $10.75 billion. On a positive note, the company maintained its construction timeline and expects Unit 4 to be in service by the first quarter of this year. So what you can see is that these power companies are moving into nuclear because it's considered a clean energy. They're not producing, smoke the same way that a coal burning factory or a electric utility that burns fuel is going to burn. So nuclear energy, obviously, there are some concerns and there are some drawbacks to nuclear energy, just like all kinds of energy. But Southern Company is investing in nuclear power. And it says, this issue may appeal to conservative income-oriented accounts. Indeed, it has a dividend yield that is above average, even by utility standards. So again, this is 4.1% dividend yield. Okay, I believe we said that was number 4. Number 5 is American Electric Power, and the ticker symbol there is AEP. We think American Electric Power will post strong earnings growth in 2024 and 2025. This one has a 4.4% dividend yield. What's interesting here, though, is that Value Line did not say this is for conservative, income-oriented accounts. It does mention that Carl Icahn has been shaking this company up. The way they put it is a well-known billionaire investor activist is looking to shake things up at the utility company. I did a little research. Icahn invested in the company, took a couple of seats on the board of directors, and they actually threw out the previous CEO and replaced her with a new CEO. So Carl Icahn, for what it's worth, is invested and involved in this company. I think you guys should know that. And it does say these shares are best suited for risk-averse, income-oriented investors. So there you go. My bad. I thought this was more of a growth play, but American Electric Power seems like more of a conservatively run company. So then you'd say, well, Jeff, seems like all the companies you've mentioned are boring utilities. The first one was wind and solar focused, and then the others are just big, maybe oil, gas, and nuclear. So you might say, hey, Jeff, I thought you were talking about something for like the next generation to supply power. So up until now, we've been looking at larger established companies. The first one was just wind and solar focused, but the others had large nuclear components. Now, the last two I want to mention to you are different. And I believe these are different because of two main things. First of all, they're both really focused on nuclear power generation. Constellation Energy, CEG. Now, this was spun off from Exelon, which is one of the earlier companies we mentioned. And the stock price for this particular company has taken off recently. It says here, Constellation Energy shares up 48% in value since our last report, have been among the best performing stocks in the S&P 500 index this year. And this has coincided with the increasingly positive benefits of public policy on the sector, as well as better than expected 2024 profit guidance. Constellation shares are likely to appeal to investors with a long-term outlook. With state and local governments joining corporations seeking carbon-free energy from the company, we have raised both our 3 to 5 year earnings and price earnings multiple projections. Together, these revisions lead to worthwhile appreciation potential out to 2027 to 2029. Whereas the earlier companies are large and more established, and Value Line felt were better suited to conservative, risk-averse investors, it looks like Constellation is more of a growth play that might be more suited to people who are investing and looking not so much for dividends, but for growth in the company and the stock. And the dividend yield for this company is 0.8, so less than 1% dividend yield, whereas the others were all roughly 4% dividend payers. The last company in our list is called Vistra Corporation, and Vistra, V-I-S-T-R-A, the ticker is VST. Now, this is an interesting company. It's a Texas-based company, and what we have here is Vistra has completed its $3.0 billion acquisition of Energy Harbor. So what they did during the past year, I believe this deal closed on the 1st of March, was they acquired another company that provided a lot of gigawatt hours of nuclear power. So they acquired that company, the deal went through. The Federal Energy Regulatory Commission approved the transaction, which helps the company progress on 4 strategic priorities. The biggest includes the establishment of a more integrated business model that includes nuclear energy. And it says here, Vistra shares are up 54% since our December report. The inclusion of Energy Harbor likely leads to a PE multiple expansion and earnings growth, which together boosts the stock's long-term appeal. So I feel as though Vistra and Constellation are in a different category than the 5 that I mentioned previously, but I think you guys deserve to know all about this area of the energy generation part of our economy. There are many other energy companies. These are not the only ones, but I did a lot of reading and research, and I just felt if I were to only pick 7 to talk with you guys about, these would be the companies. Now, at the beginning of this video, I read to you from a Washington Post article that I read that I thought kind of laid way to why there's an incredible need for electricity that may not be met with our current energy generation companies. But now that we've looked at these, I want to just kind of close the loop with another article that I read. All right, guys, so the article I'm reading from, U.S. electric utilities brace for surge in power demand from data centers. This is a Reuters article. U.S. electric utilities predict a tidal wave of new demand from data centers powering technology like generative AI, with some power companies projecting electricity sales growth several times higher than estimates just months earlier. 9 of the top 10 electric utilities said data centers were a main source of customer growth, leading many to revise up capital expenditure plans and demand forecasts, according to a Reuters analysis of company earnings reports from the first 3 months of the year. So you can see just the last 3 months. We're talking really recent data. And extrapolating from that, we're going to need a lot more energy, and it's going to need to show up soon. During the same earnings period last year, only 2 of the companies mentioned data centers. Quote, "The growth is going to kick in faster than it has in decades," said Jim Leidotes, head of equity income for Newton Investment Management. "The truth of the matter is these things, data centers, are pigs when it comes to energy use. And now they're the size of an elephant," said Eric Waddell, an expert who specializes in data center operations. Now, you'll remember we mentioned Southern Company just a little while ago as one of those 7 stocks. Southern Company expects data centers to propel its electricity sales growth to 6% each year from 2025 to 2028. Sales from its Georgia power business unit are seen jumping to an unprecedented 9% per year. So I think these are generally very large, slow-growing businesses, these utilities. And what they're seeing is the demand is turning them into fast-growing power utilities. Florida-based Nextera Energy, remember them? They were the first one we mentioned, the solar and wind-focused company. The world's largest renewable energy company said it had enough data centers in its project queue that would use more than 3 gigawatts, or nearly enough power to power all homes in the state of Minnesota. Executives from American Electric Power, we also mentioned them, an electric utility based in Ohio, said the company's retail customer demand grew 2.5% in 2023, much faster than its earlier 0.7% projection, due primarily to the acceleration of data center power use. And the last paragraph here, the rapid growth has raised concerns that the U.S. electric utility industry, historically known for slow and steady returns, will be unable to respond quickly to the rise in power demand because of a swelling backlog of power generation and transmission projects in line to connect to the grid. What we're seeing in the markets, this is a quote, "What we're seeing in the market is that these projects are not coming online fast enough to meet the local demand for the rest of the data centers," said Rystad Energy analyst Jeff Hebertson. I think that captures everything that I have to share with you about picks and shovels in energy. And I think right now, initially when I started looking at semiconductor chips and the equipment that's needed to create them, to do metrology and inspection and burn-in, I was really focused on the picks and shovels of making the chips and testing the chips. But now I'm seeing that maybe the next part of this play towards picks and shovels is looking at this energy situation. It may be that we're in the earlier innings with identifying the companies that are going to benefit from the surge in demand for data centers rather than late to this whole party, because it looks as though this demand is just starting to pick up now in 2024. So again, this is not advice for investors out there, but I feel like knowing about this stuff and being prepared as investors gives us a little bit of a head start. With some of these companies, there's the possibility that a year from now we might look back and go, oh, wow, that company was really ready to satisfy the needs of these data centers, and I'm glad that I looked into them. So I believe that I will invest in at least one of these companies that I've talked with you about. As I mentioned, I don't own any of these stocks. In the next video that I make, I'm going to talk about a few ETFs that I've found that provide access to some of these particular companies. Because that's actually how I found some of these, was I looked at ETFs that focus on this sector, and that gave me the ideas of which ones to do a deeper dive on. So if you want to know which ETFs I found and which ones I'm most interested in, then check out the next video. If you're not yet subscribed, then subscribe, hit notifications, and then when I do this electric utility ETF video, you'll get a heads up and you'll know which ones I picked of the many, many power generation ETFs out there as being the most specific and focused toward the kind of companies that I talked about today. Thank you so much for stopping by, and I look forward to seeing you guys in the next video.